So we just got numbers from Surge Energy for Q3. Production was just over 21,000 barrels of oil equivalent a day. That was mildly ahead of consensus. Let's talk now to the boss of the company, Paul Colborne. Paul, we'll give you the floor. You're never a shrinking violet. What was the big thing about Q3?
Q3 was an exciting quarter for us. Andrew, you remember how horrible. First of all, thank you for the invite. I'm thrilled. We put out our third quarter earnings last night. You remember how ugly it was in 2020 when oil, you referenced in your earlier call, hit 11. Imagine how excited for us to say our cash flow in Q3 of this year is $80 million, over $80 million, up from $27 million in Q3 of last year. Our production's up 21% to 21,400 barrels a day. So it's a thrilling time. And even though Canadian crude oil prices were down $20 in this quarter, Q3 over Q2, our cash flow, our adjusted funds flow, is actually up a little bit. So it just shows we've had great drilling results in our two core areas, Sparky and Southeast Saskatchewan, and we've had a bunch of bank-required mandated hedges roll off. So those are pretty much done now for Surge. So you're seeing what the company can actually do.
Oh, that's interesting. So under terms of your lending or your loans, you did previously need to have some hedges on?
Exactly, and they weren't costless collars letting you share in the upside. They're fairly low fixed price hedges that most companies with revolving bank lines had to put on. The good part for investors is they now are seeing what companies like Surge and Tamarack and Cardinal can really do in an unhedged basis. As you said in your prior comment, we're throwing off, I think you said gobs of cash flow or whatever. It's thrilling. Because I think you're seeing the worst I've ever seen in 2020 and some of the best times now. So it's thrilling for Surge to be able to put out. I think this will be one of the best quarters in our peer group in Canada.
What are you doing with the dividend? Just remind me, have you declared special dividends? Or I'm showing a yield of just over 4% on the stock, Paul.
Yes. So we have cash flow of kind of run rate cash flow, $350 million at Surge. On the quarter was 320, but we had a $13 million hedge loss. So you get pretty quickly to $350 million. Because we have a low decline, high net back asset base, it only takes us about $165 million of capital to stay flat. So we already started a nice juicy dividend. It's only 19% of our free cash flow. So we have a 4% yield. We've already got one of the better balance sheets. So we're paying debt down, hit our next debt target by about April. Then we'll look to push out another increase to the base dividend. And then, as you said, start looking at share buybacks and special dividends.
Now, Canaccord started covering you there resumed coverage in August with a buy. And they said that one of your big strategies has been acquiring high return conventional plays with a lot of oil, original oil in place, and low recoveries. And then you use secondary methods to get the oil out. So what kind of deposits do you like? Low oil recoveries, what does that mean?
So think of this one as, it sounds trite, but I'm just a lawyer by trade. So for business people that aren't technical, elite conventional, shallow, low risk, low cost reservoirs is what we focus on at Surge. We don't look for the high cost Duvernay's, $12, $15, $20 million wells. Think of us as boring, elite conventional reservoirs that are low risk, low cost, and they spew out your great word, I think, was gobs of free cash in markets like this. And we have a low decline. And it really highlights why we've been written up as our net asset value for the company per share with Sproul is $24. We have one of the best free cash flow yields as per 9 Point Partners research in the entire country. So to your point, these reservoirs spew out free cash, low risk, and that's why we can push out this big free cash flow yield. Currently started with the base dividend is about 4.25%. but look for us by March, April to be bumping that base dividend as we hit our next debt target.
But it looks to me like you, like so many other companies, are just avoiding big increases in production right now. Now, this is Canaccord again from August, but they have your production at just over 21,000 barrels of oil equivalent a day, and essentially not increasing next year, maybe getting closer to 22,000. So are you avoiding big production increases right now?
We are. We're deciding if we have a free cash flow yield pre-dividends that's over 30%. So I don't have too many things, Andrew, in my portfolio that are giving me a low-risk 30% free cash flow yield. So we started the base dividend. We're paying debt down. We'll bump the base. Really what we're saying, if Surge's net asset value, independent with Sproul, which is a pretty low-risk one for conventional assets like we have, is $24, is the market really paying up for Surge to stretch and provide a growth wedge or do any of the things that might want companies to trade up? Well, no, it's not. We'd rather, it's lower risk too. Keep our production flat. We have about a 10, 12-year drilling inventory, water floods, as you mentioned, and then push that free cash flow yield out. Now, Surge has been, since I last talked to you after those 2 takeovers we did in Saskatchewan last summer, been one of the top performers. So we've gone from $3.75 a share as high as $13.68. We're back at $10. But I would say over time, we're still trading at 2.5 times cash flow. Well, normally we would trade it in the market at 4.5, 5 times. So as the market starts getting Surge back to its net asset value per share and a reasonable multiple, that's when we might put in a growth wedge. For now, low risk. Let's push out that 25-30% free cash flow yield to shareholders through debt reduction, which increases the net asset value, dividends, share buybacks, and special dividends. So all that free cash flow, Andrew, we're pushing out to people probably before we add the growth wedge.